Greetings, Dr. Jeffrey Scott. This is my weekend market update for May 14th, 2023. Well, the title I put first was How Long Can Big Cap Tech Keep the Markets Close to Recent Highs? And as the day went on, and as I did more and more charts, I pulled more into neutral. And let me show you why as we go. Less bearish than I thought I would be, but still with concern about the market. Again, my name is Jeffrey Scott. My email address is hgsidoc@gmail.com. If you're new to my channel, please subscribe, hit the alarm because I don't always have a set time for posting these. And if you like what I have to say or don't, hit the thumbs up or the thumb down. It just helps me get distribution via YouTube. And if you have any comments, email me at that address or leave a comment on YouTube. Constructive are always welcome, even if they're negative. All right, let's take a look. First, this is for educational purposes only. Anything I talk about should be considered education and taken as not investment advice. I'm a doctor, not a broker. I am independent. I have paid for all the tools that I use in my daily trading and what I demonstrate today. Trading involves risk, and you alone are solely responsible for any investment decisions you make. If you like this video, I do something every morning at stocksanddocs.com. If you fill in the little thing in the lower right hand corner, you'll get notified when I post them. Now I do them, a third party posts them for me, and if I'm traveling I don't do them. So I try and do them. I did one every day this week. Major markets tell the story. First thing, despite the wonderful finish on Friday, and we'll talk about that, except for the dollar and natural gas, everything was down on Friday of the major indexes. On the week, the NASDAQ was the major index that was highest. The Qs up 0.7, the composite up 0.4. You could see the Russell was down another 1%, the NYSE down 0.9, the dollar down 1%, and the spiders down 0.3. The FAANGS stocks continue to do well, and this is a leverage ETF, but it was up 3%. And natural gas didn't move much when it's a $6 stock, 7% is 42 cents, but the natural gas is up 7.6. Leading sectors were communication and, interestingly, discretionary. And if you think about it, if this is a bad market, shouldn't staples, utilities, maybe even healthcare be leading? And then the other thing about, is this a bad market? And I'll show I think I have a picture about this. I don't know if I put it in here or not. But if one looks at through history, and I don't know if I have a slide or not, when the S&P 500 has a 52-week low, and that 52-week low here was 1013, and then you have an uptick the next day on 45% of all the NYSE issues. If you look at the 8 times that this has happened, this is the 8th. The 100% of the time they're up at 2, 3, 6, or 12 months later. And the average performance or median performance is 36%. So if that's the case, then perhaps when you look at these percentage moves, we've got some more to go. Doesn't mean the market's going higher, but you could put into the bullish camp that study that came from Sentiment Trader. And I think I may have a chart of that as we go. Well, how did the market close? You could see with this dark red here, this is a shift to the left where even though the market closed better, for the most part, most instruments were down. You could see that 63% of the stocks are below their Bollinger Band, which if you look over here, 64% of sectors were below the midline, 64% were down, 57% of industries, and 52% of stocks. So that comeback almost flipped us to a neutral day, but it still leaned bearish. If you look at 5-day performance, 91% of sectors, 72% of industries, and 68% of stocks were negative. When you look at 2 weeks, it's similar. And even when you look at a month, you could see the market has been going through a tough period of time. Now, the rates, they're probably mixed to up as there's still some inflation fears. You can see the rates up, index in yellow turned down. I still think, and I'm still concerned, and maybe I should stop being concerned, that we have a recession in our future. And why? Because these gray bars on each of these charts represents a recession. This is when the 10-2 inverts. The black line is the zero line. And you could see when it recovers, you get a recession. Here we are today. Here is the 10-3. When it recovers, you get a recession. Both of these are going back to the 90s. Here is credit, a measurement of tightness of credit. And you could see this occurs during recessions and tough times. This is back in 2008. This is the 2020 crash. If I went short term, you'd see it ticked up this week. And then perhaps one that concerns me the most is going back to the 70s. This is the the Philadelphia Diffusion Index. And you could see that every time it drops below minus 20, we have a recession. Well, we are below minus 20. So I think the odds are strong that we have a recession, but I guess I should just worry about the market I have, and I'll worry about the recession later. Breadth got worse. You could see in white, stocks above the 200, stocks above the 40 fell. And when you look here, the 12-week new high, new low stocks dropped as well. The buckets, as I showed you on the Q Edge tool, 63% below the midline. And, the preponderance of stocks are to the left, and that's a bearish formation, but not so bearish that I expect a reversal. Now, here's the shocker. We've been talking about how I've been concerned about the new lows, and you can see the NASDAQ new lows crept up, and that's bad for the bulls, period. I don't care why, but I don't see any scenario where seeing increasing new lows is a good thing if you're bullish. And notice that we're getting up to 7.6, 8.39%. The new highs are reduced. Now, I could look at NYSE Common. I could look at all NYSE, and I'm going to see the same thing. And what I'm seeing are Hindenburg omens, 3 of them that occurred last week. Now, put that in the bearish category. Why in the world would we have Hindenburg omens when we're not at new highs? Well, what does the Hindenburg omen suggest? It suggests that there's big turnover, pros are selling, amateurs are buying, lots of volatility in the market, and it predicts the market's going to fall. So I think you have to be aware of that, and you can see the NYSE, which has done much better with more new highs than new lows, is now creeping up on the new high category. So that surprised me. My friend T.G. Watkins had comments me about seeing some Hindenburgs, and there they are. Now, when I look at performance, it's all over the place. And I think these jagged lines, which show some outward performance, are tied to stocks with earnings. A lot of junk had big moves last week, especially if their earnings were decent. You could see high earnings per share growth was good, but actually here's a group that had low earnings per share rank that outperformed. High relative strength was bad. Here's a low relative strength group that outperformed. So kind of a crazy, and I basically summarized it by saying it's a news and earnings driven market. Speaking of news, I think that's 12 or 13 different opportunities for the Fed presidents to talk down the market. And I think that's something we need to be concerned about this week. If we interpret the recent Fed meeting, the CPI, the PPI, the employment of suggesting that we're going to get a Fed pivot, and if the market's being held up because we're going to get a Fed pivot, there's 10 to 12 chances for the Fed to say no. So I think they're going to guide us, whether they're leaning earlier to a cut, to a pause, or we need to do more to fight inflation. Other than that, we got some jobless claims and some home sales and inventories and production. But I actually think the big mover this week's probably going to be those arrows on the left. Plus, on the right, you can see we still have a ton of earnings to go, including some bellwethers like Target and Walmart. So, NASDAQ Lone Major Index finished the week positive, but strength in not mid-cap tech. It should have been large-cap tech. Sometimes I don't pick it up. Regional banks and pressure on their deposits continue to be an issue, except on Friday when there seemed to be improvement. PacWest down another 21% of the week. Concerns of credit tightening emerged as the economy seems to be moving towards a recession, while Congress is adding to fear with lack of progress on the debt limit. Again, as I mentioned, lots of Fed speakers will be listening for talk of a pivot. Markets like to climb a wall of worry, and for the most part, they're holding on as well as can be expected. It's hard to go in big or long short here, in my opinion. I continue to play small with tight stops and cash on the side. I think risk is asymmetric with more risk to the downside, but when you look at some of the macro pictures and the historic macro evidence, you could still see a rip-roaring move to the upside. So I think caution is warranted, and caution both ways. Not much conviction in my talk. Talk about not much conviction. Here are three correlations looking at the S&P 500 of where we are now and analogs of 1988, 1947, and 2008. You could see how we're running up very close to each of those. And the question is, are we going to take the bullish case of 1988 and break out to new highs? Do we have more chop and sideways to go, which I think is, to me, wouldn't be surprising? Or is this going to be 2008 all over again with another leg down? Well, one thing that could drive that leg down is going to be whether or not our government can get the debt ceiling fixed. How about for the bulls? This is what I mentioned before. S&P 500 after 52-week low and then a tick higher at 45% of the issues, and you could see the 12-month returns are fantastic, and it's positive 100% of the time with a median return of 36%. So based upon that, one might hope that that October 21st, 22nd low holds. How about this? Kramer used to always say there's a bull market somewhere. Well, I've been riding TGTX. I've talked about it multiple times. How many of these are you riding? These are just some of the leading stocks in the market with their return since the beginning of the year. Just something to show you. So let's go look at the charts. So right here, I'm looking at a 5-minute chart of the spiders. And the story that it tells you is, like so many days of recent, a gap up and a crap. So we gapped up at the open, stayed up for about 25 minutes, and then the market rolled over. And then something happened around 2:30, whether it's trying to bring your portfolio to some balance before the weekend. Was there some news out that I didn't see? Regardless, big rally into the end, and if you're a bull, that probably makes you feel good. If you look at the spiders, I mean, this is the story of the market we're in. I haven't drawn a Darvas box on these, but you kind of could. So let's look for a rectangle, and let's put could sort of look at. That's not what I want. We're kind of in that trading range. The good news is we are above the anchored VWAP at the all-time high, which when we rolled over in the beginning of 2022, We're pretty much going sideways at that point. We're above the 50 and the 200. Not huge volume into the end of the week. MACD looks like it wants to flip, but it's still negative. It's been sort of a bullish neutral, and I don't feel reason to change my bullish neutral picture. Q's better performer by far. As you could see, broke out, pull back to the 50, and actually have an upwards trajectory, although they were down a bit on Friday. So again, slightly bullish, a little bit more conviction than the S&P, and I think we all know that they're being driven by a small number of stocks: Apple, Microsoft, Google, Meta, Netflix, Nvidia. The diamonds, well, the diamonds interesting as well. That's a 5 minute, and you can notice they move up off the bottom at 230 as well. And the diamonds, like the spiders, are kind of going sideways. In this case, they've been going sideways for quite some time. Again, above the anchored VWAP from the highs, above the 50, above the 200. I guess you could say bullish, but I'm less bullish on the spiders. So far, I'd rank them Qs, then spiders, then diamonds, and bringing up the rear has been the Russell. And if we look at the IWM, again, here's your rally off the lows at the 230, 240 period of time. But if I look at it daily on the Russell, you see a market that I think looks probably the worst of all of them. Just holding above the December lows. Is this a trading range from here up to here, and it's at the bottom? All I can tell you is it's struggling. It's below the 50, below the 200, and unlike the other three indices, has totally broken down from the anchored VWAP from the high. So certainly the weakest of the bunch. Energy's in there, and so are a lot of banks, and that's not helping. The VIX, if you thought you'd get volatility, we really didn't. Remember, the gap up sold off and closed high at the highs of the day. VIX was actually down 1.69. But what you did see is a big reaction. Let me pull up my futures. Great. What you did see is a big move up on the dollar. And the dollar is actually, looks to me like it's breaking out and probably at risk of running up to, it's not that far, 2 or 3% more to get up to its 200-day average. Rising dollar, not really good for the stock market, certainly not for commodity-based stocks. So strength in dollar. If we look at commodities, you can see strong dollar. Gold continues to come down. Silver gets to a very interesting point here as it had a doji reversing off the 50. Now, are we setting up what John Person might call a high close doji or traditional a morning star? We'll have to watch. Gold just putting in a little bit of a flag here. Oil breaking down. What does that say about the economy? Here was the gap with OPEC cutting production, and we can't even hold in that scenario. I always like to say natural gas is dead to me, up 3.91 on the day. Is natural gas getting ready to move? Someday it'll move, just hasn't yet. And then not only was the dollar up, but you saw a reversal on the 10-year. The 10-year was up 1.94% as well. So rising dollar, rising 10-year are things that could be concerning if you're an equity holder. Now, there was a time not long ago where there seemed to be an inverse correlation between the 10-year and the NASDAQ, and if that 10-year continues to go up, that may further pressure the NASDAQ. So if I look at my weekly timing model, remember it doesn't count until the end of the day on Friday. We are above the moving average on the spiders and the Qs, green bongos, so the spiders and Qs are still in a buy mode. I've now flipped to cautious mode. I'm not all out sell mode on the diamonds, kind of a sideways move, but it's now broken down below the moving average. The weekly bongo is still green, and we're out and out sell mode, or you know, not happy if you're a bull on the Russell. So still 2, 1, and 1 favors the bulls. Conviction is relatively low. I also looked at seasonality on this week coming up, and this is one of the worst weeks of the year for seasonality. I don't think all those Fed heads are going to help us, so wouldn't surprise me to see another flat or slightly down week. On some of the other breadth things I look at, I always want to see our bonds giving me a signal. There's nothing going on with the bonds. Why would I care? Well, I've talked in the beginning about my concern that we could someday get a recession. And if you look at what happens, here was 2008, here's 2020. If we go into some type of softening of the economy, you might expect to see the TLT starting to go higher before much happens. Both of these two charts, the one on the left is the equal weight spiders versus the cap weighted, equal weight Qs versus the cap weighted. When we're pointing down here, the large caps are winning. This is the small cap growth 50 versus large cap FAANGS. FAANGS are killing them, and the Qs are still dominating the Russell. If I look at the sectors, make sure they're all set up right. Okay, so what's leading? Communications, technology, Staples is holding up, and biotech. Now, healthcare itself, not so much, but biotech. And the big winner here remains those large cap tech, the FANG stocks versus the spider. So, communications, technology, biotech. There's not much that's really kicking hard in this market. If I go into the bull scanners and we look at the heat map, you could see that interestingly, some of the large cap names that have been doing well of late were down. Google an exception. Really another strong, powerful move on Google over the last couple of sessions. I like going into Wealth Scanner, looking at my top-down indices to get a sense of what's working in this market and what's leading. So I'm looking at industry ETFs, sector ETFs, and then sometimes even type of stocks ETFs. So FANGS, Qs, triple Qs, FANGS, spider growth, biotech, although you could see it's flagging here, communications, Fidelity, Magellan. But if you look at where the big numbers are, and they've come off the 800s, it's the large cap FANG stocks. Now, let's just run through them really quickly and see if there's anything that we could be buying. So let me just adjust this a little bit. Okay. All right, so let's start with Meta. Use the right keyboard, that'll always help. And remember, I'm not using the tasty trades because they don't give me enough data. I have to use the built-in. So Meta has had just a major move after bottoming here in the 80 range, shook out a lot of weak hands, and has had just a massive run. Pulling back into the 17 certainly still looks good, hasn't really broken down. You could see the move on the weekly. All right. How about Apple? Come on. All right, we'll come Amazon. All right, here's Amazon. Interestingly, on earnings, it actually broke down here because of concern about slowing AWS. You could see, like Meta, it's had a big run off of the 80s, but it's had a run over the last several days as well. Let's go to Apple, which has certainly been one of the leaders. And you can see Apple's going sideways up here. Netflix, which we talked about a lot last week in stocks and docs, because that was one of the ones I was watching, had a nice move, had a bit of a reversal on Friday, but still holding up on the week. And then Google, we know, is doing really well. We already looked at that very quickly now, called Alphabet. I'm just showing my age. Base, kind of what the market's doing. Big volume came in a breakout. So FANG stocks continue to look good. Now, my weekend review list is a list of stocks that I put together from top downs and bottom up lists. And it's the stocks that I think have the best chance of having winners if you look at a large list. I run it into my CAT scanner. I rank by the dots. We'll start with Arlo Technologies. Now, Arlo Technologies has been running up. You could see the move here. Bit of a flag on the weekly right over here. I'm looking at the weekly chart, and then it took off again on Friday. Now, when Ian taught us flags, he would basically say, so 3 ran up to 6. So you'd expect another 2 or 3 points. So this thing could potentially still go higher, breaking out here. Massive volume, gap volume, breakout momentum. Look at relative strength in OBV. It's a cheap stock. It's not without risk, but I like Arlo. But it wouldn't surprise me to see it come in a few days. I do like ARRY. Solar seemed to wake up on, I suspect, First Solar's earnings, but a break above moving averages, large volume, breakout momentum. Look at relative strength and OBV. These are both turning up. That looks impressive. Don't Bluebird Corp. I don't know if this is Bluebird Bio or they make buses. Don't think this is Bluebird Bio. Have to figure out why. So you can look here. Buy raised to 29. It's already 26. It's not that excited. 27 cents versus 8 cents. Previous minus 31. Massive earnings beat. So Bluebird, I'd go do some research on. Again, when I see a stock that does this, my expectation is that it's going to do this before it moves up. So it would not shock me at all if we were to see Bluebird and, for that matter, Arlo pull back for a few days. That's why I typically set my buy point either above the close or above the high of the day. For solar, massive breakout, volume, gap, breakout, momentum, all bongos turn positive. Look at relative strength and OBV. It's probably getting to, I'm not sure if it's all-time high. Let's take a look at monthlies. I didn't want to put the monthlies there. Let's go back to that daily, make this monthly. Yeah, I think we're probably getting to serious all-time highs here on for solar. But look at that volume. Again, I would expect it to drift a while before it runs, but you got to put that on your list. News Corp, not a name I typically follow. Pretty deep downtrend, breaking out here, but look at all that overhead supply. Probably not chasing that. Silvercrest. Well, I mean, Silvercrest had 4 dots, but you only see 3 here because it closed in the bottom of the gap. But if you take away that topping tail, you had a gap up off of support with big volume, breakout momentum, relative strength and OBV. And remember, when I looked at silver, silver looks kind of having a reversal candle off the 50. So that might be something to watch and see where it goes. There's a lot of good stocks here. Copart, we've talked about it before. You want to find a true market leader. You want to find a stock that's lower left to upper right. Take a look at Copart. Where's the bear market? All right. This stock has been a rocket ship since September. I think it's Auto Parts. Datadog, this is an old name that if I suspect it's making its way from a stage 1 into a stage 2. If you follow Stan Weinstein, look at the rel strength at OBV breaking out above the 200 as well. Dexcom, one of these companies that are modernizing diabetes, tighter control, using pumps and technology. Chart doesn't look like much. It's off of its recent highs, but that's probably one to follow. And another one in the same basic group, I believe, is PODD, Insulet Corporation, and this one looks perhaps even more interesting. So there's a lot of stocks there, a lot of things that look interesting to me. Again, I like to rank them by 4 dots. Let's see if there's anything else. Now, energy is starting to stir a little bit. This is EQT, and this thing had big volume, breakout momentum, coming out of a squeeze, relative strength and OBV. That one looked interesting to me as well. And Range Resources is another one of these. And I always thought both of these as more as a natural gas play. So if natural gas starts to move off of its horrible numbers, those are two ways to play it. And then Hello Group, Momo, I really like this pattern as well. This is a stock that had a recent uptrend, pullback, and looks to me like it's breaking out, took out the 50 and the 17 on massive volume, strong relative strength, and OBV. If I go to my bear scanners, just out of curiosity, does anything come up with over 400? Again, looking at the sectors and ETFs. So semiconductors. Isn't that interesting? Because semiconductors, there's energy, and they're getting less weak. Aerospace, mining, oil services. I'm just curious. Let's put the CAT scanner on. And now I'm looking for potential shorts. And let's go into semiconductors. And see if anybody's going to give me big dots. Nope. Let's go into all symbols. So just like to the bullish, I can start to find potential shorts. Now, I am not advocating shorts here. I mentioned that it wouldn't surprise me to see a rip your face off rally here. It would not surprise me. Look at how SMH, this had to be a split. This isn't, I think that might be throwing this off. SANM, if I was looking to short this market, this is what I like to see. Uptrend, breakdown, retracement, and a failure. On big volume, look at relative strength and OBV turning down. So I'm sure there are plenty of things to short. I know Airbnb was another one that I looked at. Here's breaking down off the 200, failed to get back above it on the prior trading day. So I'm going to probably call it at this point. I know a lot of people ask me to put up, well, what am I going to be looking at this week? So, my conviction's not great, but let's go look at, well, let me go to the bulls. I'm glad none of my buy what showed up on the bear list. Let's just go into watch list, pull up my buy watch list. Now let me tell you what my buy watch list is. Here are about 40 stocks, many of which we've already looked at, that I will work up. And in many of their cases, I'll actually put some potential trades and load them with my broker. But I only trade if I get stopped into the trade, and I don't put a market order in on Sunday night. So we looked at Array already. AVGO just looks like it's setting up. Look at this thing. It's been squeezing, sitting on free parking, which is the 50. Relative strength and OBV are turning up. I want to see that move. BMEA has been we've talked about it before here, a nice moving biotech. Bots is a way to play gaming and robotics. It's an ETF. It's moved up. It'll play the AI and the robotics side. Cord was another of these beaten down energy stocks coming out of a squeeze with breakout and momentum. Here's EQT, First Solar. Garden Health This is a bottom fish. It's an industry that I know. It's a genomic testing company. I saw them get some upgrades this week, but that would be a bottom fisher. Google, we looked at, is breaking out one of the prettiest charts out there. Imagine Coke is on a buy watch list. Why? Uptrend, pullback. It looks like it's getting ready to run again. Here's PODD, Silvercrest. Here's a name that I hate to put up there because it just, well, let's put up, let's make this big. This thing has done nothing for a long time, okay? But if you open the chart up, you can see we've broken out here and we've run up from 9 to 13. And I think this thing's poised to go higher. This is one that I'll be watching. I'd rather buy all of these on pullbacks. Talk about a pullback, shockwave, pullback, and broke out. Probably still attractive here. I'd probably wait for it to clear sort of the 303 area before I put my money into it. So that's just some of the things I'll be looking at as an equal opportunity stock picker. I put together some shorts. We looked at Airbnb already. This one I don't understand. And maybe we'll talk about the gaming stocks and then I'll say goodbye. I just came back from Vegas. I stayed at the Encore. The Encore is attached to the Wynn. They're sort of siblings. It was packed. Vegas was packed. It was so packed that my wife and I, we go to a show, we come out, we couldn't get into any restaurant at the Wynn or the Encore. They all had an hour and a half or 2 hour wait, and this is at 10 o'clock at night. Um, Vegas is packed. Why are gambling stocks selling off? Is it a concern about our discretionary income? Is it a concern about China? I don't know. But we broke through the 50, failed it again, and gapped down. That's a weak looking stock. Hard for me to believe based upon what I saw when I was there. Party City. This one's really broken down and continues to go lower. I want to buy this on a retracement up. And another one, here's your retracement up and failure. This is Bill Holdings. So I found things to like to short, things to like to buy. I don't care which way the market goes. I'll trade the way it goes. But right now, I don't have much conviction. So if I trade, I'm trading small amounts, tight stops, keeping cash. Have a great week. See you in Stocks and Docs on Tuesday morning.